As a citizen, as a resident, as a student, or as a taxpayer of India, you should know what the government does with its money. Introducing Decoding Union Budget 2024-25. Understand in a layman's language the three most important changes in this year's budget through interviews with three eminent personalities in the business field. Hey there, I'm so glad you decided to tune in today. Our first topic is asset taxation with CA Devarajan Krishnan. So before we start, could you just introduce yourself in your own words?
Yeah, sure. So I'm Devarajan Krishnan. I'm a partner at a advisory firm called Icon Valuation LLP. I'm a chartered accountant by profession, and what I do is basically valuations of companies and assets and various aspects for corporates to either say acquire another company, for mergers, acquisitions, financial reporting, all of that.
Great. So to start off, could you briefly explain how the capital gains taxation system works in India?
So capital gains per se, right? I mean, the concept it's important to understand first. So what is capital gains is basically when you own any asset and you kind of sell the asset and exit it, you make some money, you make some profit, you make some gain. So you have to pay tax on that gain. That is what in principle capital gains tax is. Now this system works as such where there are various nuances in terms of what is considered as a long-term gain, what is considered as a short-term gain, what are the different rates applicable to different kinds of gains, different rates of tax applicable to different asset categories and things like that. So that is how the overall kind of system is structured for this. So in terms of what has changed in the current budget, primarily there are two perspectives to it. One is in terms of the holding period, or so to say, what is considered as a long-term capital gain and what is considered as a short-term capital gain. That's one aspect where changes have been done. And the other aspect is where the rates of tax applicable itself have also been changed for all those different categories. So maybe we can cover both the buckets separately one by one. So earlier there used to be kind of some listed shares, listed mutual funds, and other those kind of instruments used to have a 1 year period beyond which they used to be considered as long term. That remains now. But other than that, there used to be other investments which are listed also, which used to have a 3 year period for qualifying as long term. And then you had the next bucket of unlisted shares, immovable properties, all of that used to be considered as long term after 2 years. And then there was a third bucket where anything residual had a period of 3 years. Now all of the structure has been simplified, and there are just two aspects. If the asset is listed, then the holding period is 1 year to qualify as long term. If it is unlisted, including immovable properties, which is all these residential prices and all, including that, then it is 2 years. So that structure has been simplified to some extent. And on the other aspect, like I said, tax rates, on the long term bit, the listed scripts were all earlier, taxed at 10%, which has now increased to 12.5%, corresponding to the increase in the exemption limit from 1 lakh to 1.25 lakh. So that cap, which earlier, so whenever you had a capital gain, long term in those assets, up to 1 lakh, you don't have to pay any tax, and you pay tax only on the remaining gain. That has now increased to 1.25 lakhs. And on the other hand, unlisted, investments bucket, they used to be taxed earlier at 20%. That also has come down to 12.5. So simply put, any long-term capital gains now, which was earlier either 10% or 20%, now both of them have moved to a single rate of 12.5%. Again, having a simple tax rate structure there. Whereas any asset which is a short-term asset, which is sold before that respective holding period, earlier it used to be say around 15%, now it's around 20%. So the tax rates in general have increased for most assets, but the increases are marginal and they're not really very significant in that sense. And correspondingly, the benefit of 1 lakh to 1.25 has also been increased.
So, like we've been seeing that there is a lot of involvement of the public into the stock market, and that is the primary reason that they
Nirmala Sitharaman states for increasing the taxes. So could you like explain that premise?
Basically, there is a lot of increase in participation by, say, individual investors these days in India who invest more and more in, say, listed securities, immovable properties, and such assets. So, in general, that participation has been always on the increase. The changes that they've made are hence, twofold. One is, of course, because of that, and second is also to some extent simplify the structure itself. In which case, earlier there were, different lives for different asset categories. Now that's a little more simpler. Similarly, rates of tax are also slightly more simpler. So over the years, in all the budgets, if you see even in the previous ones, focus has been to some extent simplify, the provisions, and that is also one of the objectives that has been used for these changes this year.
Do you want to talk about the indexation, removal of indexation, and then the fact that they brought it back?
Yes, so indexation is an aspect. What that typically means is, let's say, if you would have, say, bought a property about 10 years back for a cost of 100, say, and today if you're selling it at a price of maybe, say, 180 10 years later. So what the earlier provision stated is that, for the purpose of calculating how much profit you made, it will not be directly, 180 minus 100, but you were allowed to kind of increase the cost base of 100 by something called as an indexation factor, which is basically related to how much there is inflation in the economy. So every year the income tax department will kind of come up and release, what is the rate to be used there. So you kind of compound it for that, and that 100 10 years back is, let's say, as good as 150 today, as an example. In which case you will end up paying tax only on the differential over the increased cost base. So 180 minus 150, which is the only the 30 would be your profit in that scenario. So this was the situation pre-budget, and that profit you would have paid tax at 20%. This is on immovable properties. Now, what the budget stated is that we are now moving down the tax rate from 20% down to 12.5%. So, which means a much lower tax rate, and hence they said this benefit of indexation will not be allowed henceforth. Which means you will go back to using a cost base of 100 in that example and not 150. And in that same example, your profit will be 80 and not 30. However, there were a lot of repercussions on that, and many people went and represented to them that, this change will actually impact quite a lot, because most people will end up paying a lot more higher tax because of removing indexation. So when the budget was finally passed by the parliament, they again reversed that change, where they said that, whoever has sold a property, they will have two options. One option is to go by the new provision, which means 12.5% lower tax rate, but on a profit which does not consider this indexation. Or the other option is you use a 20% tax rate, but you get the benefit of indexation, which means you have a higher cost base. So they kind of reversed it at the time of finally approving the budget. So from a user or from a taxpayer perspective, uh, you were essentially, beneficial now, and you are basically as it is, as you were pre-budget.
So do you think indexation is a good thing or should it be removed?
No, absolutely. It's a, whether good or bad is probably not the right way, but whether it is required or not, because the way, if you look at it, whatever gain you're making, if it gets offset by the fact that overall general levels of costs have increased, then essentially the real money that you're making is actually much lower, right? So that was the principle behind having indexation in the first place. So there is a sound concept behind that, and hence, keeping that obviously makes sense. So removing that was kind of something which, everyone was surprised, and that is not an ideal scenario, because essentially the profit that you make is always going to, determine how much you ultimately are earning in real terms based on the actual inflation that's there in the economy, especially from a property prices perspective. So I do think that, it is the right way to continue with indexation going forward.
Just to clarify, if the indexation was removed, wouldn't the
Hmm.
prices in the market automatically adjust so that the taxes would be included in the pricing? And so, in the long term, wouldn't it just simplify the whole system rather than, I mean, indexation is a little bit complicated compared to a flat tax rate, right?
Um, I really don't think that the prices of the properties themselves will actually adjust to that extent because both are very different, right? Indexation is something that you're using and applying on your cost base, on the cost of the property which you acquired a few years ago.
Mm-hmm.
So essentially, indexation, the final outcome of using indexation is that you end up paying a lower tax when you sell the property. So what will happen is that if I am the seller of a property and indexation, I know that if I sell the property for an X amount today, I will pay the Y amount of tax. Now, if that benefit is removed, my tax outflow is going to increase substantially, right? In which case, I will end up saying that selling the same property at the same price of X is not worth it for me.
Mm-hmm.
So I will end up expecting a much higher price for my property. So it is not always going to be helpful even in the pricing mechanism there, because people who are otherwise ready to sell at an X number will now not be ready to sell at the same X number because there is a much higher tax outflow. So they need to be compensated for that, right? At the same time, the buyer who's buying a property now also knows that he's not going to get indexation in the future. So his decisions are also going to be kind of affecting that. So I don't think the removal or keeping of indexation is as such going to really, you know, uh, be compensated by say the prices, because both are, you know, different dynamics, different markets, but they will surely affect the demand supply in the market.
Do you feel like in your life you have felt any difference with the changes brought in by this year's budget? So, like on a personal note, standard deductions or tax slabs or anything of the sort?
See, there are, I mean, some changes here and there, but nothing has changed so significantly major so as to, you know, affect things very, very significantly. They're all minor changes here and there, except maybe someone who's investing a lot in, you know, shares and all that. Maybe for them, 10% to 12.5% tax rate on capital gains is a 25% jump, which is significant. But other than that, you know, things like this standard deduction or slab rates and all of that are in some sense minor and not really very, very, you know, different.
Is there anything else that you want to talk about or go deeper into?
Yeah, so broadly, I think that kind of covers most of the changes in the capital gains segment.
Yes, okay. Thank you so much. You've done a really good justice to the topic and you've gone in detail to each topic in order. So it'll be really easy to listen and
Yeah.
understand. And you've explained all the basics, which really helped. So thank you so much.